Welcome. We will just wait 1 more minute so that everybody can join the webinar. Well, welcome to our webinar, An Expat's Guide to Smart Saving and Investments in Norway. My name is Natalie. I work for Stavanger Asset Management and Noon Invest. Together with us today, we have our guests, Emilie Refseth and Oddgeir Vik from Deloitte. And I have my colleague, Jon Nerseth from Noon Invest and Stavanger Asset Management. Program today is that Oddgeir Vik from Deloitte will start and followed by him, Emilie, and they will try to answer all your tax questions. And then I will do a market comment, and then John will wrap it all up with introductions to investment. I just want to remind everybody that on the bottom you can see this Q&A and chat function. If you have questions during the presentation, send them in, and then at the end we will try to answer all your questions until the time runs out, and then we will wrap up all the questions and try to answer them by email or to call you. So we can start with Oddgeir Vik. He's going to do a presentation on wealth tax, valuation of domestic and foreign assets for tax purposes.
Hello, my name is Oddgeir Vik. I work in Deloitte law firm in a group called Global Employer Services. We mainly serve global corporations with issues from their employees working abroad, and also foreign employees working in Norway. And in addition, we have also clients that are private and needs assistance on various tax issues. Natalia and Jon asked me to say something about the special Norwegian wealth tax or asset tax. I'll try to do a brief explanation on the rules, especially when it comes to valuation of the various assets. And also, I will say a few words about exit tax on shares when leaving Norway. I'll try to share my screen now. Let's see if we find that. I hope that's visible. No. Okay. The wealth tax is calculated based on the values. Sorry. Again. I'll try again.
Tapper ut til meg. Den, ja. Share. Nei, ikke den. Den. Nei, ikke det presentasjonen. Nei.
Seems like I have a bit problems here.
Stop sharing. Stop av video. We will just give Oddgeir, yeah, he's back on now.
So, I hope that's visible now. Not. Okay.
Looks good. So just continue.
Do you see me? Okay. Sorry about that. Norway is one of the few states that imposes wealth tax. Historically, the thought for the wealth tax was to equalize the tax burden between wealthy people and the not so wealthy people. And it's been heavily discussed in the political forums whether we should keep the wealth tax or not. I'll come back to this. The wealth tax is a tax that is levied on resident taxpayers. You become a resident in Norway when you exceed 183 days in a 12-month period, or if you exceed 270 days in a 36-month period. Norway has also entered double tax treaties with various countries, and some of the treaties will have a reduction in the tax liability for certain assets. If you are considered a non-resident taxpayer, you are tax liable for properties located in Norway only. When it comes to valuation of the various assets for tax purposes, the government has used the wealth tax to direct investments in the way they want to be invested. For instance, most Norwegians own their own home, and the authorities say that wealth tax should not be any burden on owning a home. But still, your home is a basis for wealth tax. But to reduce the burden, you will have 75% discount for the basis of wealth tax, a 75% discount compared to the market value on the property. Then again, we have what we call secondary properties. That's rental properties, other properties that you may own. The discount on such properties is only 10%. That is a decision from the authorities that they will not encourage the increase in the cost price of property, especially around the big cities and Oslo. If you have a holiday home, a cottage, or that's the basis is the market value less 10% discounts. The government also wants investment to be done in the business activity in Norway. So for 2019, there was a discount on 25% from the market value of shares. But this summer, and due to the situation with the coronavirus and the lockdown and so on, they decided to increase the discount to 35% of market value. Properties abroad will also be tax liable to Norway. The value of any property owned abroad is a maximum of 30% of the market value. It's not said that the tax value should be 30% of the market value, but 30% is the maximum value. We also have discount on commercial properties. Here is the discount 25%. When we, one of the many questions we receive is regarding foreign pension plans. Norwegian pension plans is not subject to wealth tax. But again, most foreign pension plans will be subject to Norwegian wealth tax. The main rule is that the taxable asset is a taxable asset if the scheme appears to be a savings plan. Let's say the plan says that after you are 62 years, you can withdraw the funds as you like, the whole of the plan or parts of the plan. In that case, it is considered a savings plan and not a pension plan. A pension plan says that you cannot withdraw the funds in one go. It has to be proportioned through for example, 10 years after resigning. But our experience is that when it comes to pension plans, we have to assess each pension plan to determine the tax position. So there's no quick answer to the question of tax liability for pension plans. The wealth tax is calculated on the basis of gross assets less any personal debt you may have. But then again, if you have assets subject to a discount, like I mentioned before, deductible debt is reduced proportionally. So it is a bit complicated and technical, the calculation, but if you own shares which are reduced with the discount of 35%, a part of your debt is also reduced with 35%. This reduction does not apply for family home or what's called primary property. There are also tax-free allowances. For single taxpayers, the tax-free allowance is on 1.5 million Norwegian kroner. For married couples, the tax-free allowance is 3 million. So basically, if you are a single taxpayer, you start paying wealth tax when your assets reduced with deductible debt exceeds 1.5 million. And the tax rate is 0.85%. Just a comment on that. The tax rate, as you will see, is 0.85%, and that's not much. But then again, we have privately owned companies doing well in Norway, and then again, the shares will have considerable value. So one problem is that with the wealth tax is that it is a tax payable, but the value cannot be realized in money. So that means that the owners of, let's say, family-owned corporation will have to use dividends from the company to pay the wealth tax. And then again, for that reasons, there is a risk that family-owned enterprises will move abroad. But then again, that's politics. At the end, I will mention the exit tax on shares. If you break tax residence to Norway, you will have a liability to pay tax on gain, potential gain on shares. But then again, the gain that is calculated as taxable gain to Norway is the increase in value on shares in the period you are resident in Norway. And it's also applicable if the calculated gain exceeds 500,000 Norwegian kroner. If it's less, if it's 499,000 kroner at the date you break tax residency, it's not taxable. It is also payable if you move to a state outside of the EU, not payable if you move to a state within the EU. The tax, let's say you move to the UK. No, that's not a good good example. if you move to Denmark and have a latent gain exceeding 500,000, there is a tax liability, but the tax is payable if you sell shares within 5 years. If you keep the shares in the 5-year period from leaving Norway, the calculated tax claim will be released after 5 years. An example, here is a market value on 1.5 million. You have cost price and value when you moved in on 900, and you have a latent gain on 600,000. So this is a short description on wealth tax and exit tax on share. I will now stop my part of the presentation.
Thank you very much, Oddgeir. Just want to remind you again, if you have any questions regarding Oddgeir's topic, just write them in on the Q&A section below, and we will try to answer after. I want to give the word to Emilie Repseth. Her topic is an introduction to the Norwegian healthcare and social security system.
Thank you, Natalia. Can you see my screen right now?
Yes, but I can see your notes as well.
Oh, okay. So is this good? Let me see. Okay. Can you see my screen right now?
Yes, confirming.
Okay. So my name is Emilie Repseth. I work at Deloitte here in Stavanger with Oddgeir and my team, and we specialized in global mobility. Today I will be talking about the Norwegian National Insurance Scheme. So to be entitled to services from the National Insurance Scheme, NAV, in Norway, you must have a compulsory membership, or you must be accepted as a voluntary member upon application. Examples of services provided through the National Insurance Scheme in Norway are treatment by a doctor, psychologist, sick pay, child benefit, and pension. And there are 3 main social insurance schemes in Norway. The first one is the National Insurance Scheme, NIS, the Family Allowance Scheme, and the Scheme for Cash Benefits for family with small children. And membership in the National Insurance Scheme is the key to be entitled for rights to services from NAV. And generally, individuals are members of the NIS either through permanent residency or by performing work as an employee. You can also be a member of the NIS during stays abroad. It's the provisions of the National Insurance Act or the Social Security agreements Norway has with other countries that will determine whether you are a member or not. It's important to know that your membership is not determined by whether you are a Norwegian citizen registered in the National Population Register or whether you pay taxes to Norway. So the first one, the member as a resident. So if you live in Norway, you are as a general rule a member of the NIS. And in order for you to be considered resident in Norway, your stay in Norway must last or be intended to last for at least 12 months. And membership requires that you stay in Norway is legal. And for people outside of EU, that means you need to have a resident permit. When you move to Norway to be here for at least 12 months, you become a member from your date of entry to Norway. And yes, the first one as well. When you are a member as a resident of Norway, you can stay abroad for up to 12 consecutive months and still remain a member of the NIS. And you can also commute between Norway and abroad and be abroad for up to 6 months in 2 or more years. The second option for membership is to be a member as an employee. And even if you do not live in Norway, you can have a compulsory membership in the NIS. If you, for example, work in Norway or on the Norwegian continental shelf, or if you are a citizen of an EEA country and work on a Norwegian vessel. Yeah, let me see on the second slide here. The NIS is funded by contributions from members with personal income and employers and the Norwegian state. And the contribution rates are set once a year. Membership in the NIS scheme, that means that you must pay national insurance contribution to Norway if you have income from a pension or from work. And the level of payment is 8.2%, which is calculated from your personal gross income or pension. Norway has signed national insurance agreements with many countries. You can see from this list all of the countries. And these agreements regulate your national insurance membership, and specifically which country that will providing you with coverage. And generally, you should only be covered by national insurance in one country to avoid double payment. Generally, the Social Security agreements state that an individual is subject to the Social Security legislation in the country where the work is performed. Exemptions are made for individuals that hold a certificate of coverage from another country. I'm sure you heard of that. And please note that there are special rules for citizens of Canada and US. For these countries, you will only be granted a partial exemption. If you are working in or moving to a country which Norway has a social security agreement, you must find out what your rights are under the individual agreement in question. And the agreements make sure you'll have the same rights and obligation as do nationals of the country where you're staying. Individuals from agreement countries are treated equally, regardless of nationality. As a rule, you will only be covered by Social Security in one country, and consequently, you do not have to pay Social Security contributions to both countries. And Social Security agreements also make it possible for workers who are temporarily posted to another agreement country for work to retain their membership in Norwegian national insurance. There are special rules for NNIS membership for work in an EEA country, a European country. Norway is a member of the European Economic Area, EEA, and thereby subject to the EEA regulation on Social Security. According to the said EU regulation, you are as a main rule subject to the Social Security legislation of the member state in which he or she works. Exemptions are granted for individuals seconded from another member state, in general for a period of maximum 5 years, if the sending member state authorities have issued Form A1. It is the A1 form that proves that you pay social contributions in another EU country during the assignment, and correspondingly is exempted from the NIS. And you must submit the A1 form to NAV. And as you can see on this slide, you remain as a mandatory NIS member when each period of work performed abroad does not exceed 12 months, and the salary is continuously paid from the Norwegian employer, and the employee spends at least half of non-working periods in Norway. So now we have learned that residents in Norway and employees performing work in Norway are, as a main rule, compulsory members of the Norwegian national scheme. Work or long-term stays abroad can end your membership in the national insurance scheme. And the consequence of not being a member is that you no longer have rights pursuant to the National Insurance Act for doctors, etc. And when your membership ends, you are no longer obligated to pay national insurance contribution to Norway. It is possible to remain as a member of the NIS during work abroad, either under the EU legislation, social security agreements that Norway has entered into, or the Norwegian domestic legislation. If you do not fulfill the above-mentioned terms for compulsory membership in the Norwegian National Insurance Scheme, you may be entitled to a voluntary membership. If you have a compulsory membership in the National Insurance Scheme and will be staying abroad, the stay abroad may mean that the membership in the National Insurance Scheme ends. For instance, if you exceed 12 months, you will, as a rule, a general rule, no longer be a member. And to continue your membership in NIS, you must apply for a voluntary membership to NAV. You may be entitled to a voluntary membership if you have been a member of the NIS for a minimum of 3 years during the last 5 calendar years, and you are temporarily posted to another country for work, and you have a close relation to the Norwegian society. Finally, I will quickly mention that this week the government announced that the child benefit has increased, and parents with children under the age of 6 residing in Norway are entitled to a monthly child benefit of Norwegian kroners 1,354 per child. And this is an increase of 300 NOK per month. And the child benefit has actually increased 3,600 a year, which is quite a big amount. And my last slide, I would just like to end this presentation with showing you Deloitte's latest tool, because we know that it's been challenging to stay up to date on the travel restrictions and all the regulations applicable in the country where you're planning on traveling. For instance, if you plan on going on a business trip. And Deloitte Norway has, together with Deloitte member firms, developed a tool, and it's called Go Work Map. And it helps companies to manage their employees' global mobility and business travel. And this map is free to use and provides up-to-date information about quarantine, immigration compliance, and travel restrictions. So please have a look at this. Click on the link gowork.gs.deloitte. So I encourage you to visit that and share it with your friends and clients. So thank you for your attention.
Thank you very much, Emilia. And just reminding again, if you have any questions for Emilia, just use the Q&A function, and then she will answer at the end of our presentation. Yeah, it's my turn to share with you our market comment. So I would like to start with the corona crisis. So new cases are falling on a global basis, except for India. India has less financial impact than, for example, US, and the US are new cases are falling. So that's good for the stock market. More and more countries has started reopening, and the economic consequences after the pandemic seems to be better than feared. There is some danger of it flaring up again, but we are more equipped and prepared than in March. We have better knowledge about treatment, and lately we've seen a lot of young people getting infected in a way that's positive because of the less hospitalization. There is a light at the end of the tunnel. There will hopefully be a medicine or a vaccine just around the corner. Yeah, I'm not going to mention a lot about the trade war. There's been a lot of strong words, but virtually no change since the agreement in January between the US and China. So we have the US election coming up very soon in the beginning of November. I read an article and they said that the worst for the stock market is a close race. The market does not like the uncertainty, and that one cannot prepare for what is happening. Yeah, the market doesn't like that. So what happens if Trump wins again? Normally, it's positive for the market if a capitalist or a Republican wins. What happens if Biden wins? In my opinion, international relationship may be better. So a little bit about the oil crisis. After lockdown, global demands for oil has fallen, as you can see in my chart. We've seen an improvement after the reopenings, but there is still a risk of undersupply when normalization. And I would love to share with you our view on oil company as an investment, because we can see a huge green or ESG trend, green investments. For example, if an oil company goes to a bank and they want a bank loan, that will be difficult these days if they don't have a green production. And I listened to a podcast yesterday on E24, and the Storebrand, a big Norwegian bank that manage over 800 billion Norwegian kroners every year, were the guest speaker, and they was talking about their green investment plan, and now they're excluding a lot of the big oil companies like Exxon and ConocoPhillips. And Storebrand, they believe that to consider environment will generate higher returns. So we see that the big institution, big pension funds also exclude non-green production oil companies. This will have a big impact on the oil company prices in the near future or the far future. So we have, although we had some extreme movements in the currency the last couple of months, we're back to where we started this year, which is a low or a weak Norwegian kroner, NOK. And I want to talk a little bit about this slide. The question is the stock market disconnected from the rest of the world? As you see in, for example, S&P 500 index in the US, they are almost 60% up from the bottom. But I want to mention that a lot of the returns, or almost the entire return, has been driven by tech companies. So 75% of the S&P 500 index are still in minus. So there's still a potential there for investors. I can mention Oslo Børs, the stock exchange, still in minus. We can see that Oslo Børs is more driven by the oil prices than the rest of the world and the reopenings, the corona crisis. The Hong Kong index, that's a little bit on the side because they had other issues that made the index not rising as much as the rest of the world. Yeah, so we can see that the markets are almost back from where we started before Corona, but there's still some potential left in the market, potential for gains. Market looks ahead to capture future developments. Our inception is that the market is not disconnected from the rest of the world. Why? Because we have significantly lower interest rates, the most powerful stimulus of all time from central banks. The law on alternative returns applies. That means that there is no better alternative than to be invested in the stock market. The value of future cash flows on listed companies becomes higher when interest rates are lower and the real economy is improving. So we in Noon Invest and Stavanger Asset Management have been overweighted in equities because we believe that the risk premium is reasonable in relation to the alternative investments. Okay, so this is a fun fact. So Norway had 60,000 new private investors in the last 6 months, and 67% of those again is below 40. So the young, as I would say, has cracked the nut. Even including previous financial crisis, in the long run, the stock market has risen by an average of 10% each year. So I did a lot of research yesterday, but I also read about this theory in E24. It's called the K formation. That's we have the V. You can see the stock market, it looks like a V, how it's evolving. And we have the U and we have the L, and yeah, it's a lot of theories. But now I want to tell you about the K. So if you can imagine this K, okay, so the market is rising and then it's dropping very steep, and then it's rising again, but the market is splitting. So we have the companies that are winners on the stock exchange, and we have the losers. So the winners is like the tech companies, the biotech companies, the groceries, and then we have the losers, that is transportation and oil and etc. But that's just a theory. But it's fun to just imagine how the market is evolving. Yeah. So I want to wrap it all up. How do we think? What should you do now? So our advice is that everybody should be invested, have a monthly saving plan and stick to the plan. Even if the market drops, you should keep saving into the crash, during the crash, and out of the crash. And we believe in a global diversified portfolio. Find a suitable risk profile for you. Are you young? You don't need the money next 10 years, 20, 30 years. You can maximize your gains by being in a high risk profile. If it's 2 years left before you're are going to take your pension, yeah, I don't know how you say it, retire, then maybe you should consider a little bit less riskier plan. We use rebalancing. It's a term that the Norwegian oil fund use, and the plan is that when stocks are rising, they become more expensive, you sell them, and then you invest in the stocks that has fallen because they're cheaper. And then in the long run, this has been very profitable. And another fun fact is that the Norwegian oil fund was the biggest investor during the financial crisis in 2008-9, and Norway gained a lot on that. And for last, if you have the possibility, use the market corrections to implement a larger share of your financial savings. Yes, that was me. Thank you for your attention, and I will give the word to my colleague John. I will stop sharing the screen. I managed to stop sharing. John, you can unmute yourself.
Hello, John Nerseth from Stavanger Asset Management and Uninvest. Thank you for the people still hanging in there. So I'm going to say a little bit about savings in Norway, saving and investments in Norway. Let's see if this works. No? Okay, there we go. So first of all, who are we? Stavanger Asset Management is an asset manager, as the name says. We've been operating here in Stavanger for 10 years. We have Swiss roots, and as of the last 3 years, we also run Uninvest, which is a digital platform for saving in index funds. I'll just start off with, of course, investing is very, very easy. So no worries. No, that's why we are here to help out for those who don't have all the knowledge or don't feel they have all the time to spend on this. First of all, if you want to save in Norway, there are basically four different ways, I would guess, tax-wise to invest. A lot of the wealthier people in Norway hold a holding company or a stock company that they invest through. That gives them some tax benefits when investing in shares, especially. Of course, as mentioned earlier by Deloitte, we do have pension schemes and insurance. What should I say? Ways of investing through insurances. The most normal, of course, is private ownership. You buy a share in your own name, but that is not the most tax, should I say, beneficial. The last couple of years, there's been a new opportunity for private people who do not have a holding company or investment company to buy stocks and equity mutual funds through a ASK or aksjesparekonto, a stock savings account. That is definitely beneficial for investing in equities, in shares within the EEA. There's some limitations there. Fixed income is not allowed. and also investments in US or outside of the EEA is not allowed in this. So if anybody wants some help about these things, feel free to contact us. We know how this works, and of course Deloitte are experts. So please ask if you have questions. What really matters, I think, is very important for an investor. And what we see through history is that the investors generally do not get the returns that the markets produce. There are several reasons why, but I think one of the most important factors is not sticking to the strategy. When trying to time the market, people often stumble and do not get the returns that the markets actually give. We see this in both short and long run. Of course, cost is a contributor. The more you pay, the less you receive. That's an easy conclusion. And another thing that Natalie mentioned is the oil fund uses the strategy of rebalancing. I'll tell you a little bit more about that soon. So first of all, strategy. The Norwegian government, or through the Norges Bank and our oil fund, did an analysis of the US pension funds, and they saw that this investment strategy of the funds contributed to as much as 90 to 95% of the total return. So just the strategy, not any tactical moves along the way. And Peter Lynch, a legendary investor and asset manager, also said that far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. So trying to time it is, you're probably not doing yourself a favor. What should we invest over time? Natalie mentioned this. If you have a very long horizon, if you're saving for your pension 10, 20, 30 years ahead in the future, you should definitely consider owning more stocks and less bonds. If you look at one of the most popular investments this year and also the last 20 years, it's gold. If you look at a 200-year perspective, it's giving you almost zero return in real return. Of course, the only thing worse would probably be to put money in your mattress. The inflation over time will eat up your money. So that's not a good plan in the very long run. So what is I mentioned the pension fund. I know the Norwegian government pension fund, the oil fund we call it, now 10,000 billion Norwegian kroners, quite significant investor in the world equity markets. They've looked at rebalancing, and they looked at data back to 1970, and the conclusion is that rebalancing strategies yield a significantly better relationship between return and risk. So risk reward, as we call it, is significantly better. We will use this strategy. It's the only, what should I say, trick that actually is statistically seem to work over time. There are no magical formulas. So if anyone is trying to sell you a magical formula for investing, run away. So the last couple of years, especially here in Norway, there's been a big debate about what's called active funds and passive funds, or even closet index funds. There's been some lawsuits. There's a new lawsuit maybe coming up in the same topic, where asset managers are charging high fees for doing active management of funds. And when you look closer at the funds, they are actually very passive. They are very much like the index itself. So DNB lost the case on this, and there's a few others who are in, what should I say, in the limelight of this topic. And what we've seen also the last 10, 15 years is a massive growth in the passive fund market. active funds have been losing ground, and the money has flown into the passive funds, so-called index funds. And this trend has not stopped, it's actually accelerated the last years. So why is this? One reason is plain and simply the cost. People see the charges of 2% in some cases on mutual funds, and they see that index funds might cost as low as a tenth of that or even lower. Another thing is the statistics for the active funds around the planet have not been very good. If you look in the long run, or over a 10-year period, only 2% of global active funds have actually beaten the benchmark index. So being invested in an index fund would, in most cases, give a better return than a large majority of the active funds. Of course, that being said, the best funds would always have to be an active fund, but necessarily also the worst performing funds will be active funds. So there's no holy grail in this, but through index funds or passive investments, you are at least certain to keep track of the market. So what is an index fund? What is the difference? Well, an index fund is basically an ordinary fund, same laws, same rules apply, but they have only one task, that is to track the index as close as possible. The index itself is dynamic. It's being changed or rebalanced every approximately two times a year, depending on what index you're looking at. So the index itself is dynamic, and to follow an index, all you need is a computer, basically. You don't need expensive asset managers or a big team of analysts to try to beat the index. So what you end up with is basically a fund following the market with much lower costs, and so far with better returns than most active mutual funds. So what about the 5-star funds, the funds who have performed the best? These are being measured all the time. Morningstar is a big site for following index funds, following funds on a global basis. Together with the Wall Street Journal, they looked at all the 5-star funds and tracked them the next 5-year period. What you saw was that after 5 years, only 12% of the 5-star funds were able to keep their 5 stars. And as much as 10%, almost as many, fell to the bottom 1-star rating, which is basically the 10% poorest performing funds. So past performance, so a 5-star fund might definitely not be the best fund in the future. So it's very difficult to kind of see who are the best active funds out there. What about index funds? Is there anything you should think about? Yes, there are several things you should think about. I mentioned Aksjesparekonto. They have limitations also in this field. You can't buy American index funds, but you can buy European index funds investing in America. So there are things to think about here. Of course, price is just one factor. We care about liquidity and risk and tax and currency and how they're basically put together, which could be several ways. I will try to wrap this up. I mentioned we started Mooninvest 3 years ago. It was the first so-called robo-advisor in Norway using index funds. The whole idea is to make this much easier for the average citizen to invest and to get a solid index fund portfolio, and basically getting everything set up from at home or from your cabin in 5 minutes without papers or meetings. And I would like to close this off by quoting Warren Buffett, who says that by periodically investing in an index fund, like Natalia mentioned, have a monthly savings plan, the know-nothing investor can actually outperform most investment professionals. So that is some good words by probably the best investor in the world. I think I'd finish off with that. mute and put you back to Natalia.
Yes, thank you, John. Very interesting. And I'm overwhelmed by all the good questions here. So I think I want to say thank you for everybody who's been listening. We're going to sit here for 10 to 15 minutes answering the questions. Yeah, just stay tuned if you're interested to listen to the to the answers. And yes, so I would just begin to say to all Americans that I've been calling around today, trying to figure out if there is any possibility for you to do investments in Norway if you're a tax resident in the US. And I've got some contacts, so I'm going to post my number here in the group, and then you can call me and I will direct you to the right people. John, you can maybe move the Q&A slide. I would like to start with a tax question. So the first question that came in was, where can we find the tax treaties that Norway has with other countries? So Emilie or Oddgeir, can you answer this question?
Yes. Please go ahead, Oddgeir.
Yeah. The tax treaties are issued on the government website. So you just Google Norway tax treaties. You should find it quite simple.
Yeah, and you can also have, isn't it collected in the working and living in Norway? You can find that on Deloitte.no. A list
but not
of all the tax.
Yeah, but not the treaties
yeah,
themselves.
correct. Yeah, correct.
Okay, thank you. Google it. Good answer. Okay, so I receive income abroad. Am I liable to register my assets in Norway? And who calculates, or do I calculate the values?
Yeah, as I said, if you are a tax resident to Norway, you have liability on the wealth tax on your global assets. So doesn't mean anything where they are situated. It's tax liable to Norway, and it's your own evaluation that's being added to your tax return. It will not be pre-filled as Norwegian assets are, so you have to include that yourself. And then again, give enough information to avoid any penalties from the tax authorities.
Thank you. Can I deduct the total sum of a foreign credit card?
I think the short answer is yes. Any debt is deductible.
Good. I got assets in Vietnam. If I send this amount to my bank account in Norway, my Norwegian bank account, do I have to pay tax?
Yeah, not any tax due to transferring the funds, but you have to pay wealth tax on that, even if you do not transfer it to Norway. As I said previously, tax is liable on a global basis.
Thank you. Is there any tax on gains from stock ownership in Norway, if not tax resident any longer?
Yeah, the only tax from Norwegian shares is tax on dividends. There is dividends are taxed at source in Norway, but then again, if there is a double treaty with your resident country, you will have a credit for the Norwegian tax in your resident country.
Yes, from a tax point of view, would it be more beneficial to have accumulated index fund or a dividend paying index fund? John, maybe.
Yes, yes, I can answer that. Well, basically, in theory, there shouldn't be any real difference for a fund keeping the dividends and reinvesting them or paying them out. Of course, if you pay out dividends and spend the dividends, you will end up with less at the end of the road. So reinvesting the dividends would definitely give you a long-term higher return. But other than that, if a company pays out a dividend or keeps the dividend, the total value should be the same. So it's only the reinvesting of the dividend over time that will benefit you. So.
Thank you. Could the exit tax be avoided by selling to under the 500,000 NOK limit and rebuying when leaving the new country?
Yes, as I said, the limit is 500,000 Norwegian krona. So if you are planning to move out of Norway, you could make an evaluation on your latent gain and to avoid being struck by the exit tax. But then again, if you move to the EA or the EU, the tax will not be payable until you actually sell shares. But then again, it's much hassle, paperwork, confirmation each year in 5 years to the Norwegian tax authorities. So keeping your gain under 500,000 would be good.
Thank you. Wealth tax. Is cash taxed at 100% value?
Yes, I didn't mention cash. Cash and bank accounts are all taxed with 100%, and the value is by the 31st of December in the tax year.
I just want to make a little extra point there. I see that there was more of a tax question to the dividend part, and yes, that is one of the benefits of aksjesparekonto and holding company is that you don't pay tax on dividends in these two schemes. On a private basis, if you invest, you will have to pay taxes on dividends along the way. So in that sense, an accumulating index fund or a fund would be better. So yeah.
Social security question. Is Germany not part of the NNIS membership list?
Yeah, I can answer that one. I think I answered it directly also to the one asking. But Germany is part of the EU regulation. So when I had the map on the slide, it was not included the European countries.
Okay, thank you. Okay, if I have a home in the UK, is this considered the primary home or abroad? And the same person also asked, my property value will be the one paid for it or the market value?
Yeah, we have had discussions with the tax office regarding properties abroad and if it should be considered primary home or secondary property. Our point of view is that if you do not own a property in Norway, your property in the UK should be considered your primary property. And the next, there was 2 questions.
Yes, sorry, I'll read it again. My property value will be the one paid for it or the market value?
Yeah, you should, for foreign properties, the rule is that the tax value is up to 30% of market value as per the 31st of December.
And the same person said that we don't own a property here in Norway, we are renting.
Then that should be classified as your private home. So I would recommend an estimate on the market value at the end of the year and calculate 25% of that for tax purposes.
Yes, thank you. John, maybe you know a little bit about this. Interest rates on house mortgages, how and when to get better rates?
Yes, how and when? I think when is always. Always, or at least once a year, every second year, contact your bank or check with some other banks because we know that there's a possibility to get lower interest rates by simply asking. So by not doing that, you're not doing yourself a favor. Of course, interest rates I mean, we don't know the future, but they are extremely low at the moment, historically low. And the banks are, even though interest rates have been falling, or the central banks have put the rates lower, and not all the banks are as fast to follow up on lowering your interest rate. So ask them. That's my best advice.
Okay, I think I'll do the last question now. What happens to the following if we leave Norway? Pension saving, employer contributions, personal contributions, government, and etc. Try to be short.
I'm not sure if I can give a short answer to that, but main reason is that leaving Norway, breaking tax residency, will not lead to any taxation on assets other than shares, as I said.
Yes, okay, thank you. I think we will wrap up now, and the question that is not answered, we will answer them by email or call you. John, maybe you can bring the slides with the email addresses so people can write them down if they have some questions after the webinar. Thank you for guesting us, Deloitte, Emilie and Oddgeir. And thank you for everybody that's been listening. We will send the PowerPoint slides and the recording of the webinar after, maybe tomorrow or yeah, very soon. Okay, thank you. Thanks for us.